Hey everybody, this is Brent from Wolf on Wall Street Trade, and we're going to take a look at the market, what happened last week, what it looks like we're heading into next week, and in particular, one interesting chart. So first, let's pick up where we left off last week. This is a daily chart of the S&P 500. So last week, we left off right over here, and we did get a little 3C negative divergence right in here. So that just said the pace of buying here was starting to slow down, and there were some sellers. So this is kind of something that's not too unusual to see when you start transitioning from a trend into a consolidation. And if I back this chart up just one day and take Friday off, you can see this consolidation. It looks a little bit like a ascending triangle. So that's something like this, which would be a bullish consolidation. So remember where we left off at the end of last week's video was that I didn't have any trend lines drawn, but there was a pattern of higher highs and higher lows. So the bulls were still in control. And if we go to a couple of the other major averages, like the Dow Jones, you can see it more clearly over here in the form of a rectangle, which is a little less bullish. It's still a sideways consolidation pattern. Here's Friday if I add that in. It was the same thing with NASDAQ 100. And there you can see this kind of sideways range. Of course, this was the heaviest week of earnings season this previous week. So we had a lot of that, a lot of movement in individual stocks and some sectors, but it didn't really affect the broader market too much, which was pretty much in a holding pattern, waiting, listening, and seeing what the earnings were about. And then we did end Friday higher over here. So that was on trade news. Pretty much the real moves here, like here and over here, these are both trade news, trade headlines. And IWM, or small caps, pretty narrow range this week. So here we are, close at 1550 over here, close at 1550 over here, 1552. 1550, and then ended the week up at 1558 or 185. So you could see again a really small lateral range for small caps. That's kind of the theme, except for this trade news that moved the market on Friday. Dropping down to a 15-minute chart of the Dow, there was a lot of dispersion too between the major averages, which is a little bit unusual, but the theme was that they were all consolidating different forms of that. So here you see a rectangle in the Dow, and it spent most of the week trading at the bottom of that rectangle. And then here's the NASDAQ 100. So it spent the week pretty much in a rectangle here. On Friday over here, we got that trade news. So it moved above that triangle on the trade news, which is right there. You can see more evidence of the market consolidating. When you look at the 10-year yield, it's pretty much flat over here. It went up a little bit on Friday again on that trade news, but this tells us that the bond market is in the same phase of sideways consolidation or indecision. And even the dollar-yen pair, pretty much sideways in this triangle. So it's a symmetrical triangle, and the range is pretty much narrowing. Again, it spiked up a little bit here on Friday due to that trade rumor or trade news, trade headline. And there has been a ton of volatility. Let me show you on a daily chart. So here's a daily chart of the NASDAQ 100. Don't even pay too much attention to the trend, which is very choppy and pretty much lateral, but take a look at the candlesticks. And I started using these. I learned how to use these when I first started trading, and what I really like about them is you can glance at the chart real quick and you can get a lot of information by looking at the candles. So let me back this chart up to the earlier part of 2019. And again, you can see the trend is very different, but that's not what I'm trying to point out. Check out the candles. You have the up days in green, the down days in red. You have a lot of up days. You know, you get 4, 5, 8 days in a row strung together, and you don't have very many big down days except over here at the end of December when we're coming out of that sell-off. So just eyeball those candles for a minute, and then I'm going to move the chart forward. And here we go. Now eyeball these candles. I mean, a vast difference in price action. You have a lot of really big candles, both up and down. You have a lot of tails, wicks on the top of these candles, on the bottom of the candles. You have a lot of gaps. So this has been very volatile trade, and this is one thing I was pointing out earlier in the week with NASDAQ 100 before this trade rumor spiked the market on Friday. I just backed this chart up one day. So, and let me zoom in a little bit. So that is a very volatile consolidation. That's not typical of a bullish or even bearish consolidations. Consolidations are usually much lower activity, smaller candles, and a tighter price range. So a lot of volatility, and of course part of that is earnings season. But as we just saw, you know, for like the last 3 or 4 months, has been really heavy volatility. A lot of rumors and news moving the market, a lot of gaps. So a lot of the price discovery has been in the overnight session. And one other thing to point out, especially in October, This is a 15-minute chart of the Dow from the start of October. So this is the October 1st close. So from there to where we closed on Friday, the S&P, or I'm sorry, the Dow is up about 1.5%. So it's pretty much close to where kind of opened the month. Over here, this is the end of the close of the first. Now take a look at volatility. It has been virtually straight down except for the very first day of the month. This is almost a 40% decline. So you have the Dow up about 1.5% from the close of October 1st here, and you have the volatility, or the VIX, down almost 40%. That's pretty striking. The market did ramp up on Friday over here, and that was on a trade headline, and it nearly made a new record high. It approached that new record high. This is the 30-20 level over here in red, which is where the market was rejected in September when it made a run for the July record high, and it closed at 30.2178. So the record high is at 30.2586 from July 31st. We'll look at that in a minute. And really, you know, a lot of the movement, or most of the movement in the market recently, has all been these trade war stories, or trade war rumors. So here was one, a big move into, you know, the potential of a trade deal, which was announced over here, and the market came down a little bit sideways through earnings, this kind of ascending triangle, and there it is again above 30.20. That is Friday's headline, and it's a little absurd at this point, but you know, it is what it is. It's going to be with us for a while. So the headline was that negotiators were close to finalizing some sections of a partial trade deal. This is nothing new. I mean, this is what was expected to be done back here. It wasn't done. It wasn't on paper. So now they're saying we are close to finalizing some sections of a partial deal. But, you know, the market is going to react on this stuff when it's in an optimistic mood, when it's trending higher like this. And this is going to be with us for a long time. So this, again, as a reminder, this phase one deal is basically, we'll buy beans if you take off tariffs. So China has the negotiating advantage in trade talks right now. They came into the talks over here and said, we're not talking about anything except for beans for tariffs being removed. We're not willing to talk about the bigger issues, and they really have Trump in a corner at this point. I think his time has dwindled down into the 2020 election. At this point, he can't put too much more pressure on them, and they are not going to make any kind of comprehensive deal until that election. They're going to wait it out, see if he gets defeated in the election. So, you know, why would they agree to something that's going to affect them for decades when they can wait another year and just kind of try to string along this whole thing and reduce the tariffs as much as possible? And on Trump's part, he doesn't want to increase tariffs and have the economy turn down even more into the election, or in the farm states, have those states go against him in the election. Now on to the record high. So we got real close to that, actually traded above it intraday. And for me, it brings up a little bit of deja vu, because here is the record high. That's July 26th. That happened to be a Friday, and it happened to be 1, 2, 3 days ahead of the FOMC right here, the first time that they cut interest rates in this cycle. After they cut interest rates right here that day, market did not take it very well, and Trump escalated the tariffs. He had a 6+% sell-off, you know, in the next 4 or 5 days, the next week. And the last time we were in this area, again, over here in September 18th, right here, is when the Fed cut rates for the second time. So here's the first time. Market was near, or at, an all-time high. Over here it came near it. This is where it was rejected at 30.20. And there is when the Fed cut rates. And you can remember maybe this area where we saw a transition from bull flags to bear flags, and then this kind of decline. It was, I called it an orderly decline at the time, and kind of chugged around here. There's the trade optimism right there, the trade deal announced here, and here's the next trade headline from Friday. So we're right back at that area. Guess what? Just like back here in July, 3 days before the FOMC, which is next Wednesday. So here are my little notes here. Fed cuts by 25 basis points off a record high. Sell-off cuts again over here in September, 25 basis points. Market comes down 3 days ahead of that right now. So it is major deja vu. In my opinion, before we even got to this 25 basis point cut, many months before, or at least a good month before, was that this is not going to be a one-time cut or a mid-cycle adjustment. It's going to be a rate cutting cycle. So here we go again. And we're set to see rates cut one more time next week. The probabilities are at 94%, so you're going to have basically 3 rate cuts in 3 months. Months and months ago, I got my members ready for all this. We looked at historically, how these cycles have gone in terms of rate cutting cycles or the economic cycle. You might remember we looked at the S&P 500. Let me roll this chart back. From way back here, 2004, 5, 6, 7, into 2007, when the cycle did start to turn, yield curves flattened out, they inverted, and then they steepened again, and the Fed started cutting rates. So I'm going to zoom in on this area, which is coming into the 2007 high in October. And I'm just going to add some of the notes that I've shown before. So this is the May high, and then we made a slightly higher high, less than 3%. And curves were already inverting, and all that stuff was already happening, so we were already late cycle. And then the Fed started cutting rates, and we made one more record high in October of 2007. So they first did a discount rate cut, then they did a 50 basis point cut to the Fed funds rate. I'll just walk this forward. And then very shortly after that, there's the record high. So you have two rate cuts right there and a discount rate cut. Right now we have two rate cuts presently, both to the Fed funds rate, which these two both were. Then we come in, and again, within 3 or 4 months here, you have a third rate cut into the Fed funds rate. So you can see that here. And then the market kind of kept on going. We got into the worst part of the financial crisis. My point really with this whole thing was just what you can kind of expect. So different things happen, late cycle, things develop, like curves invert and then steepen sharply right before you go into recession. Here's the recession over here. And that the Fed usually is cutting rates when the market is at an all-time high. So the economic data is kind of going like this. Stocks are going like this because the Fed's cutting rates, and the market wants to believe that that is going to save the day. One chart I want to touch on real quick was BKX, or the KBW Bank Index, just say the banks broadly. So this is one I've been watching for a while, and I haven't liked financials, quite frankly, since May of 2018. I'll show you why. Let me pull up XLF. So some of the members might remember this. We saw this in real time. We had a bull flag right here and a failed breakout right there, and 3C went nuts. I mean, price was going up and 3C was going straight down. And from that point on, financials never acted well again. They didn't make new highs with the market here in 2018. They haven't done so in 2019. But getting back to the bank index, the point I'm getting at was that there's been this level of former support over here around 103, and that turned into resistance once broken. This is a perfect example of former support once broken turning into resistance, or vice versa, and you can see it around 103. It did move above that level this week, and I suspect maybe, I'm not sure, but I think maybe we could see some better performance from the banks and the financials, and I'll show you why. In white, this is the 530 yield curve, and this is the bank index. So into October, the yield curves, or this yield curve and most yield curves, have been steepening sharply, and that's good for banks. So you can see BKX in the candlestick here has gone up once the curve started steepening and leading higher. So that's important support for banks, and that's why I think, it had this extra support. It was able to break above that 103 level in BKX. However, while we're talking about curve steepening, there's one thing you have to be aware of. I think most of my members know exactly what I'm going to say at this point. Here's the 10-year minus the 3-month yield curve. So this is 0% over here. Below this is inversion. So this is the yield curve inverting, and this is that recent steepening that I just showed you. So it's out of inversion here. And so many people have heard about inversion for such a long time with negative connotations. They probably think that this is a good thing. This is not a good thing. But it is the reason that banks are performing a little bit better, and probably BKX broke out above that 103 level, at least to this point. So here's a broader view of that going back to 1982, and these gray areas are recessions over here. There's 0. So this is yield curve inversion below 0. Over here, you can see it over here. And what happens, that is the warning sign. The warning sign that the bond market is pricing in, starting to price in a recession. But what happens right before a recession, when the bond market has figured out the Fed is behind the curve, you see this really sharp steepening out of inversion and into recession. You can see it here, you can see it over here, and you can see it over here. So that is the very start of what we saw in that very short-term chart, just moving out of inversion through this steepening. Does that mean there's going to be a recession next month or next year? I don't know that stuff. All I can tell you is that historically, this is what happens every single time. This is GLD, the ETF for gold. This is a daily chart. I'm going to zoom in a little bit to this area over here. So about a month ago, before we came into October, I had posted some charts of GLD on the videos, and I said it kind of looks like a head and shoulders top. This would be the neckline, but I don't think it is. And then somebody asked me in the video in the comments, why don't you think it is? And I said, these are the most misdiagnosed price pattern. It looks like a head and shoulders top. The price pattern is kind of almost secondary. The volume confirmation is the most important thing, because if you don't confirm it with volume, if it doesn't have the exact, not the exact, but if it doesn't have the trend of head and shoulders top in volume, just ignore it. So a lot of people, I think, were seeing this, and it turns out it was not a head and shoulders top. Sometimes you just need to let price finish consolidating and giving you a little better look at what the real story is. So this could have been a potential breakdown if it were a head and shoulders top, but watch what happens. It jumps right back above, well above that trend line where the neckline would be. And at that point, even if it was a head and shoulders top, it would be a failed head and shoulders top. But if you just let price develop a little bit more, what you start to get is this downward sloping parallelogram. And if I put some trend lines on it, that's what it looks like. Forget about this one in the middle, but that is what it looks like. And if I back this chart out a little bit, here it is on a daily chart. You can see it real clear. It took a little bit of time, 2 months to develop, but you can see it real clear. That's a big bull flag, similar to the one that we saw over here into May. Bought it, I think the day before it broke out, and had a great trade on the long side. So this is a nice big bull flag. It's something to be aware of. I'm not going to go into too much detail here because I think this may be a open trade in the next week or so. And I think we're going to have massive, massive volatility in gold next week into the FOMC on Wednesday. So gold is one of the assets that tends to knee-jerk a lot. But I really do like this, and I will update this next week as we come to it. For members, it will be in real time, of course. If you want to see a head and shoulders top, this was a head and shoulders top. Apple 2018. Here is your shoulder. Here's your head. Here's your shoulder. And what really made this clear was not the price pattern. It's not even that great of a price pattern for a head and shoulders top, but it is visible. It was the volume confirmation. So if I pull up the volume, check out this rally over here. Volume's okay, right? Moving up okay. But look at the decline over here. Volume is increasing. Over here, look at this rally. Volume is lower. It's not increasing, but look at this decline over here. Volume is moving higher, okay? So that is what you want to see to confirm a head and shoulders top. And then on the break, big volume. There it is there. And watch this decline. Bear flags all the way down right into the end of the year. I think Amazon is probably the highest probability of a real head and shoulders top. Shoulder, head, shoulder over here. They never look like the textbook. They're not always symmetrical. And take a look at volume. Let me just tighten this up a little bit. So there's the pattern. Over here, volume on the decline from the top of the left shoulder. Volume is pretty high. You don't get a good rally here on volume on this rally. And check out the decline. Volume is high again. And over here, volume is just kind of big and nasty. This was earnings. So this neckline is about 1,700. A break of that neckline would have a target of about 1,400 for Amazon. Okay, so let's wrap this up. Remember, the big important event next week is the FOMC on Wednesday. They are expected to cut rates. I think the percentage expectation is something like 91% for a 25 basis point cut. So real quickly, a couple levels on the S&P 500. This 30-20 level has been important. That is the September area where the S&P was rejected, could not make it up to the July high at 30.25. And then here's 29.44 that I've been talking about and harping on for weeks. The S&P and all the averages did end the day on Friday with this very small bullish flag. So this is right above that 30.20 level. And if it breaks out of this flag and makes an equal leg move, that is up to about 30.45 over here. And keep in mind, we're getting really close to the top trend line of the broadening top. Here's a 2-day chart of the S&P 500 with that broadening top. Let me pull this down a little bit so you can see where that trend line comes in. That is around 30.58, 30.60. Remember, the more time it takes to get there, it's going to be slightly higher because it's an upward sloping trend line. The 3C chart of SPY, which I showed last week, had just started to negatively diverge into the consolidation most of the week. looks very similar to what it looked like over here in July, which is to say very, very poor confirmation. Excellent confirmation in June. I mean, it was moving with price, it was leading price, but then we got into July, not so much. And here's what 3C for SPY looks like. So in last weekend's video, we had a negative divergence right here as price had popped up over here on Thursday morning. So while most of the averages like NASDAQ, Dow, and small caps were almost dead sideways most of the week in differing ranges, and S&P had more of an ascending triangle or slightly upward sloping trend, the 3C charts basically stayed flat throughout most of the week. And that wasn't a big deal to me as long as, you know, what we saw in the Dow and stuff like that, it was flat. So 3C was flat. That's saying there's really no underlying buying activity of any consequence or no selling activity of any consequence. What is, however, interesting is the move on Friday over here. 3C did not move up and make a higher high or confirm, just stayed pretty much dead flat. And I'll run through the other averages real quick. QQQ did look a little bit better towards the end of the week. At least 3C was confirming and moving up with price, although not spiking, and obviously not higher than it was over here. So that is a relative negative divergence. Let's pull up the diamonds or the DIA. Over here, just no activity at all. And again, remember that this was this really lateral rectangular range in the Dow, and 3C just stayed flat, as you can see over here. Didn't do anything on Friday to confirm this move up. And IWM, real quick, small caps. They had negatively diverged at the end of the week that ended the 18th. So basically, again, they were flat most of this week, hovering around that 1550 area. And this is Friday's move on the trade news. So again, really no confirmation here. Spent the most of the week flat. Came in with this negative divergence, as I was talking about in the beginning of the video. That's often seen when you go from like an uptrend into a consolidation. So for most of the week, 3C didn't say much, but what it did over here on Friday was it did not confirm these gains. And that's pretty much how the market looked in July, as the market made these marginal new highs, like 0.1% or 0.2%. There was no confirmation at all. It wasn't sharply diverging, but it was like this, where it was just kind of leaking lower and not interested. The buyers just weren't there to support it. So we have kind of a similar situation, at least as of the end of last week. Okay, so that will do it. If you have any questions or comments, go ahead and leave them in the comment section. Members, just email me. As always, check out my Twitter feed. You can see the link for that below. And if you like the video, give it a thumbs up. I would appreciate that. And have a fantastic weekend, everybody.